Have you ever noticed something strange? Two retirees can start with the exact same amount of money, say $500,000. And 25 years later, one has quietly crossed $2 million, while the other is slowly worrying about running out. Same starting number, completely different ending. So what happened in between? Today, I want to walk through this calmly and logically. No hype, no secret trading strategies, no side hustle millionaire energy. Just math, psychology, and one shift in thinking. Let's start with someone realistic. Imagine Mark and Elena. They're 62. They live in Ohio, or maybe southern France. The numbers aren't that different. They've done well. Between their 401k, IRA, maybe a small pension, and some savings, they've accumulated $500,000. Their house is mostly paid off. Their kids are grown. They feel safe. And to be fair, $500,000 sounds like a lot of money. But here's where things quietly split into two paths. Let's assume they withdraw $40,000 per year to supplement Social Security or state pension. That's about $3,300 per month. Their expenses might look like this: property taxes or maintenance, $600, utilities and insurance, $400, groceries, $700, car expenses, $500, healthcare premiums and out-of-pocket, $600, travel, dining, hobbies, $500. Nothing extravagant, just a comfortable middle-class retirement. Now here's the key question. What happens to that $500,000 over 25 years? There are two very different ways retirees manage their money. The first approach feels safe. They move everything into low-yield accounts, savings accounts, maybe short-term bonds, very conservative funds earning 2 to 3%. Why? Because they're afraid of losing money. And that fear makes sense. After decades of working, the idea of market volatility feels dangerous. But let's do simple math. If $500,000 earns an average of 3% annually, that's $15,000 per year before withdrawals. But they're withdrawing $40,000. So each year the account shrinks by roughly $25,000 plus inflation impact. Over time, the portfolio declines. Even with careful spending, inflation eats away purchasing power. A 3% return in a 3% inflation world is basically standing still. By their mid-80s, they're watching the balance fall faster. They didn't overspend. They didn't make reckless investments. They just played defense for too long. Now imagine someone else, same $500,000, same age, but instead of shifting entirely into safety mode, they stay partially invested in productive assets, broad stock index funds, dividend-paying companies, global exposure. Not aggressively, not speculatively, just intelligently. Let's assume a long-term average return of 7%. Historically reasonable, not optimistic. Now, $500,000 growing at 7% earns about $35,000 per year on average. They withdraw $40,000, so instead of shrinking by $25,000 per year, the gap is much smaller, around $5,000 annually, sometimes even less in strong years. And here's where compounding changes everything. The power of compounding in reverse. Most people understand compounding while working, but retirees underestimate that compounding still works after retirement. If the portfolio grows at 7% and withdrawals are controlled, the money doesn't just last, it can continue growing. In fact, if withdrawals are modest relative to returns, something interesting happens. The portfolio stabilizes, then slowly increases, then compounds. Over 25 years, $500,000 growing at 7%, even with disciplined withdrawals, can realistically cross $2 million in certain scenarios, not because of magic, because time plus productive assets still work in retirement. The secret formula isn't a stock tip. It's not real estate flipping at 70. It's this: understanding that retirement is still an investment phase, just with a different risk balance. The mistake many retirees make is psychological. They shift from growth mindset to preservation mindset too aggressively. They confuse volatility with danger, but inflation is also danger. Longevity is also danger. Living 30 years in retirement is normal now in the US and Europe, and 30 years is enough time for compounding to either work for you or quietly work against you. Why do intelligent people make this shift? Because losses feel worse than gains feel good. Behavioral finance calls this loss aversion. If a retiree sees their portfolio drop 15% in a bad year, it feels catastrophic, even if historically normal. So they escape the discomfort. They move to cash. They sleep better, but slowly, invisibly, inflation begins eroding their future. This isn't stupidity, it's human nature. There's also a structural problem. Financial media focuses on protecting retirement. Banks sell guaranteed income. Advisors emphasize safety. The word risk is framed negatively. But risk has two sides: short-term volatility risk and long-term purchasing power risk. Most retirees eliminate the first and unintentionally increase the second. A simple dollar example. Let's compare two 25-year outcomes. Scenario A, 3% return, $40,000 annual withdrawal, 3% inflation. Over time, purchasing power shrinks. The portfolio declines significantly. Scenario B, 7% return, same withdrawal, same inflation. The portfolio has a strong probability of surviving and growing. Even a 4% withdrawal rate historically allowed portfolios to last 30 years or more in diversified stock-heavy allocations. And if withdrawals are adjusted slightly downward during market downturns, sustainability increases dramatically. That small behavioral flexibility changes outcomes by hundreds of thousands, sometimes millions of dollars. They don't chase returns, they don't panic sell. They understand that volatility is temporary, but inflation is permanent. They think in decades, not quarters. They don't ask, will the market drop this year? They ask, what will my purchasing power look like at 85? That's a completely different lens. Let's extend the timeline. If a retiree reaches 90 with $2 million instead of $300,000, the difference isn't luxury, it's security. It's better healthcare options. It's helping grandchildren with education. It's sleeping peacefully without calculating every expense. And interestingly, retirees who maintain growth exposure often spend more confidently because their money is still working. This doesn't mean being reckless. It means balance, maybe 50 to 70% equities instead of 10 to 20%. Maybe global diversification instead of local-only bias. Maybe adjusting withdrawals during bad years rather than locking in losses. It's not about squeezing maximum returns. It's about respecting the mathematics of time. Here's the uncomfortable truth. Retirement isn't the finish line. It's just a different phase of the same game. Money still needs to grow. Compounding doesn't retire just because you did. The retirees who turn $500,000 into over $2 million aren't financial geniuses. They simply avoid shutting off growth too early. They stay invested. They stay rational. They allow time to continue doing what it has always done. If this perspective helped clarify something for you, consider subscribing. No hype here, just calm, long-term thinking.